specifically on the UK mortgage market, but I think that most people in the room will find that this resonates in local markets as well. And what we're going to talk to you, rather than talk directly about kind of price optimization, it's the lead up and to understand the customer behaviours and how customer behaviours are going to change over the next year, 2 years, 3 years, as the environment changes for lending and also for deposit taking. So, if I can get this right, there we go. So I'm just going to take you through the kind of the pressure that's building up in the UK mortgage market, and anyone from UK lending banks here will probably understand and appreciate that pressure that's building up. What that means for 2016. I'm joined by my colleague here, Keith Green from Berkeley Research Group, and Nomis Solutions work with Berkeley Research Group on the regulatory implementation of changes. So pricing is not straightforward in terms of implementation of pricing in banks. Obviously very, very tightly governed, particularly in the UK, by regulatory. And some of these regulatory changes have big impacts on pricing strategies. And Keith is going to bring you through some of that. And then how we actually get to solutions and managing the agenda. So just before I go forward, just to give you some of my own background, I'm the Managing Director for Nomis Solutions. Nomis Solutions provides banks. We work with a number of UK banks and European and South African banks, as well as in Canada and the US. And we work in large kind of retail portfolios, mortgage portfolios, lending portfolios, deposit portfolios, in providing, I suppose, price optimization solutions. So this is around understanding those customer behaviours, setting those optimal prices within the market, within the portfolio, and ultimately for two reasons. One is in order to meet those customer expectations, and number two is in terms of enhancing bottom line or balance sheet metrics. So typically we would see, in an annualized basis, an improvement in margin of somewhere between maybe 15 and 20 basis points in large portfolios of mortgages or deposits, and probably in excess of that for personal lending portfolios. My own background, I'm actually a banker, so I worked my whole life with Bank of Ireland for 25 years. I was our head of deposits and transactional banking, and also the head of the SME lending side. And also head of the customer analytics in Bank of Ireland. So I decided after a quarter of a century of banking, I decided to give it a shot out in something else. And I found this very fascinating because a lot of banks really don't leverage that data that they have. And this is really fascinating in how much data banks have that they don't leverage for day-to-day pricing. And you're going to understand if you can improve that pricing in a mortgage portfolio by just 1 basis point, that's got a massive, massive bottom line impact. So I just found this fascinating, and I'll take you through what we're doing in the UK mortgage market. So if we look at the UK mortgage market, there's significant pressure building up. What we're finding is attrition levels within the existing portfolio have reached real critical levels. So we're finding the customers now are shopping around, looking for different prices within the market. We're seeing that banks are effectively running to standstill in the UK. So we see gross lending has increased significantly over the last number of years, but overall portfolios are remaining relatively static. We're seeing the entry of challenger banks. So new smaller banks. And new smaller banks are coming into the market, and they have a very different outlook on pricing, and they have a very different outlook on the portfolio, and they're going to be certainly cherry picking. And usually these challenger banks have better use of data. Margins have been squeezed. So what's happening in the UK is very interesting in terms of the margins, and I'll show you some figures here. And effectively, bottom line has been squeezed, and it can't go on any further. Regulation is getting tighter. Potential in the UK, and who knows, we've heard potentially the US Fed is going to increase rates in December. Maybe not. Bank of England, most likely, Mark Carney has said that consumers need to prepare themselves for higher lending costs next year. So the likelihood is that we'll see a base rate change in the Bank of England next year. European, probably a little bit further in. I would suspect maybe to 2017, middle of 2017, when we'll actually see a rate increase. And then the distribution mix within the market has changed dramatically as well. And that's for two reasons. One is from a regulatory point of view, it's so much more convenient for customers just to deal with brokers. So they're not going through that process with numerous banks. So customers are saying, well, I want speed, I want transparency, I want to get in there quickly, I want to get the best price. Why would I go to 5 banks and go through a process of documentation and interviews and so on? So we're seeing the kind of the mix change. So this is where house prices are rising. So in the UK, since the start of 2013, we've seen UK average house prices rise by about 25%. So that's a significant increase in such a short space of time. And obviously, at a regional level, you see London prices, southeast, have increased significantly more, a little bit less in other parts of England, Wales and Scotland. But overall, 25% increase in average house prices. Now, what's interesting about this is it's creating what I call liberated switchers. So up to that point, up to 2010, 2011, 2012, people were sitting on, negative equity or fairly flat equity. Now we're seeing a lot more customers coming into positive equity, and as a result, they are at liberty to switch. They're at liberty to move mortgage bank and get a better deal or deal with another bank once they're liberated. And that is extending every day. So we're seeing these liberated switchers increase on a daily basis as a result of falling LTVs and rising house prices. New business rates. Anyone from the UK banking? Is there a number of people from the UK banking? So you're all familiar with where the rates have gone. So your average 2-year fixed, so at the start of 2013, was just shy of 3% for your average 2-year fixed. Seems to be a very popular product within the UK banking market. That is sitting down now at 191. Okay, so the average price. So what's happened to base rates in that period? Nothing. Okay, so base rates have remained the same, yet the competitive rates within the market have come down by up to 50% in some cases. So you can see the discounted variable, so this is trying to attract new customers into the book, has fallen from 3.18 when the base rate was 50 bips down to 1.61. Okay, so a significant drop in average UK rates. The other thing I mentioned was the broker channel. So the broker channels have increased significantly as well. So back in 2013, if we take first-time buyers, we'll see first-time buyers represented about 54% of the broker channel. Now that's about 3/4. So 3/4 of first-time buyers originate their mortgage through their mortgage through broker channel. Okay, so that's another shift in what's happened in the market. So overall, between first-time borrowers, home movers, remortgages, we're seeing increases of about an average of about 38% going through broker channel now. And then we can see the gross lending versus outstanding. So most of the banks are growing their gross lending. So we can see gross lending predicted by about 50% over the last 2 years. Yet overall books have remained relatively static. Okay, so outstanding mortgages have remained at where their levels where they were at 2013. So significant change in that. And what this tells us really is that there is a very big focus in going out and driving volume, going out and a lot of churn in the market, a lot of people switching over to other banks. So we're seeing that continue. So gross lending is beginning to tick up, but nothing is happening with the books. So it's running to stand still. And then finally, if we look at the big banks, the big banks are pushing the volume change. Okay, so we can see that the top 5 banks have increased their lending by about 20% on a gross perspective. Other banks, about 9%. So we can see that these banks here are pushing this volume objective, pushing that growth. And at the same time, what's happening is obviously margins are being squeezed. Okay, so there's more growth going into the market or more gross lending. So it's cannibalization of what it is. It's back book going into other banks, and I suppose it's creating or removing value, but creating an issue for the long term. So what? So what's going to happen? So if we look at 2016 as we go into this, so we've seen 2013 to 2015 a significant shift in what's happened in the mortgage market. But as we look forward, margin compression is a massive issue. So average margin from about 268, and what I'm taking here is between, say, base rate and average lending, new variable lending rates, have reduced by about 58%. So that's putting significant pressure on bottom line margin of it. And the resultant, I suppose, push is let's grow volume. Let's keep on growing volume. So margins being squeezed to such an extent, what's going to happen next year? Is that going to continue into 2016? So when base rates rise, we're going to probably see that margin being compressed even further. People will be alerted when base rates rise. There'll be a lot more switching. There will be a lot more price sensitivity in the market. And we're going to see a lot more churn within these books. What's going to happen here? The zone of the unknown. So is the base rate going to go up 50 basis points? Is it going to go up in the first quarter, second quarter, third quarter? Do banks predict and know when this is going to happen? And do they, more importantly, know how they're going to react to this, how they're going to react to base rate changes? So what we do with banks is we are constantly modeling those effects within the market. So for example, as base rates change, what is the bank going to do in terms of passing on that base rate change? Is it going to pass it on to certain customers, all customers, certain products? When is it going to do it? Is it going to lag the market? Is it going to lead the market? So we do all this kind of sensitivity changes. But we also want to understand is if Bank A does it before Bank B, how is that going to affect Bank A and Bank B? So the zone of unknown, I suppose, is do we really understand the consequences of the base rate change for next year? A lot of banks now are managing that in terms of planning for 2016, both in the mortgage market and in the deposits market. It's the same instance. What will happen then when the base rate changes, customers will become more alerted to it, because particularly on the mortgage market, you'll see base rates change. People will now start to look at, well, how am I, if this is the trend, and it will be the trend, base rates will continue to rise over the next number of years then. People will want to lock in their money. They'll want to get the best rate within the market. It'll create a significant amount of churn within the market, and that will continue. And I suppose understanding what's going to happen here is what banks need to do more with data, and that's where the customer behavioral analytics comes in. Customer expectations have changed. So price sensitivities will change in 2016. So customers over the period of the crisis, they're a lot more financially savvy. They have a lot more access to information. The regulations are pushing more information within the market. Customers demand speed, transparency, efficiency. Price may not be their first port of call. In fact, what we've seen over the last couple of years is that in the deposits market, more customers now value speed and efficiency of service over the price. Now that could be a product of the fact that prices are extremely low at the moment for deposits, and that may change. But at the moment, that's where the value the customer sees. So customer values have changed, and to understand how they're changing requires that kind of deep analytics. And then finally, then you've got, let's call them challenger banks. And the challenger banks are coming in and they don't have this big back book to manage. Okay, so they're going into the market and they're saying, what type of customers do we want? What customers will create us long-term value? What customers can we take from the larger banks at a price point that is acceptable and then grow that base? So they don't have this big back book to look at. So it's cherry picking the right customers, and price will become an aggressive piece. So what do the larger banks do when an aggression on pricing, when base rates changes? Do they follow? Are they worried about it? And more we're seeing these challenger banks coming into the market. And the last thing, I suppose, is the regulatory changes. So the FCA is obviously looking very much from a risk perspective. How are banks managing their existing customers? They're very concerned about the existing customers and how they're being managed. One of the key dependencies of any pricing manager is probably how much inertia is in the book and taking advantage of the inertia in the book. And this is what regulators are looking at now. How do they try to remove some of that inertia through communications, publications, and so on? So there's a lot of pressure on the banks now to look after the existing customers and to try to counteract some of that inertia within the books. So I'm going to ask Keith now just to maybe take us through some of these regulatory challenges, which are overlaid with some of the economic and financial challenges.
Hello everybody, my name's Keith Green, and as Damian's mentioned, I work for Berkeley Research Group, and we work with Nomis on the regulatory side as an advisory firm. Quickly before I go in to this, my background was initially pricing. I ran some product teams for lenders, and then slowly through an integration of moving to an external policy role where I had plenty of time with the regulator and the EU Consumer Agreement relating to Residential Property Directive. I moved from a product role through dealing with the regulatory authorities and then into consultancy, where now I specialise in regulation. I think in terms of regulation, it doesn't directly, to some extent, impact product pricing. When I was a pricing manager, I didn't sit there and worry every day about what the FCA was going to do or the PRA were going to come out with. However, it does have an external effect that flows through how the business is run. And at the moment, I see three real key areas where I'm expecting regulatory change to become more interesting moving forward. And I've got some more detail on those. I think the first one we're seeing is what we call regulatory convergence. So both within the United Kingdom itself, regulators are learning from other regulatory regimes. So the FCA, through the replacement of the controlled function regime in mortgages, we're going to go to the new standard function regime that they've just implemented everywhere else, and they're going to kind of normalise that across products, but also globally. So I was very lucky to work out with the Office of the Controller of Currency in the US. So the FCA and the PRA now spend a lot of time talking to their American colleagues and Chinese colleagues and colleagues around the world. And what you're seeing as an organisation now is that if you're not looking out into the wider world, seeing what's happening in other countries, that could potentially come and hit you in the products you're designing moving forward, because the FCA is taking lessons from what's happening with arrears in America, and so is the European Union, and the Financial Stability Board, which kind of run it all, which is run by Mark Carney, is trying to get a generic set of policies that control global banking to capitalise to restrict the impact of globalisation on banks. In terms of regulatory hotspots, my specialism is mortgages, and specifically more on the conduct side than the prudential side. And these are the type of 5 kind of items that we've picked out as thinking of areas where there's going to be key focus over the next few years. The FCA is currently out there looking at customer detriment, so they're looking at responsible lending policies, and they're going to come back next year and talk about their views on how responsible lenders are being in terms of the products. One of the interesting things in buy-to-let is that historically it's never been regulated in the UK, and predominantly, not even within Europe, it's never really been big enough. But the Bank of England are now so concerned about it, and the fact that they think it could bring down the housing market if it went, if the bubble blew up, that they want the powers to regulate it. And interestingly enough, unlike other countries, at the moment in the UK we don't have direct product regulation. The Bank of England have powers to restrict LTVs, but I know in Damian's country of Ireland, when I was out there over a couple of months ago, they actually, their regulator completely prescribes what products you can offer. They set your LTVs and they set your limits on what product design you can do. And the regulator's been very clear in the UK, if they think that the market is potentially exposed to a bubble, they will step in and use the LTV limiting powers the Bank of England currently has to restrict lending growth. The bottom 3 then come to more interesting focus. Interest only has been an issue for some time with the regulator. One of the problems they have with interest only is the fact that you get artificial forbearance, where people get to the end of the deal, they can't repay the loan, you just extend it and make it a lifetime deal. There's a wonderful capital requirement coming in, I think it's called IFS 9, which basically is suggesting to banks that in the event that you do that, that's actually classed as forbearance, and you have to provision 100% of the loss for all interest-only loans in that forbearance. Lenders clearly are not keen on that, and are pushing back to say they don't particularly want to have to put hundreds of millions of pounds aside to cover loans that they probably in reality wouldn't have done in the first place if they'd have known where they ended up. Existing customers, this is going to be, I think, the next battleground for the regulator. It's quite interesting in the UK market. In simple terms, existing customers pay more, and most banks' boards couldn't tell me why if I asked them. and it's probably because you can charge them more, has been my history of being pricing. I know Tony mentioned earlier that the regulators are that it's all about the customer. And the regulators are, guys, it is all about the customer. And if you've got a cost model where you just charge them more, they're going to see that as a conduct issue. What you have to be able to show is that there's either a value reason why, or there's a customer opinion why they want to pay more and that they've chosen to do that. And if you can't show that clear line for your product pricing up to your board, you're going to have some problems in the future. And finally, distressed customers. In the UK, we've had bank base rate at 0.5% for a very, very long time now. Some interesting statistics came out from one of the speeches from the FCA recently, which said when bank base rate goes up 1 million customers, it will be the first time they've actually had an increased payment on their mortgages since mortgages have been done, which is a lot. Of that, the Bank of England think 280,000 will have severe payment difficulties, and that's just with the first payment increase, not a suggestion of those. And if you look at the stats from personal household and credit card debt, that's gone up by about £10,000 post the credit crisis, an increase of about 172% on average for most people in the country. So if you understand that most people have taken the low bank base rate and used that as an opportunity to take out borrowing, they are quite concerned about how lenders are going to do that and what their pricing strategies will be. And just quickly, the final point that we wanted to make is this new area that seems to be coming up, which is behavioural regulations. So historically, it's all about pricing, capital, understanding what's going on. The regulators are now increasingly focusing on behavioural regulation, which is basically saying, are you biased? The existing customer point is an apt one. Why do you charge people more? Because we always have, and that's just the way it's been done. The regulator now considers that a key problem in the UK market. One of the problems with things like biases and the way you incentivise people and everything else is generally you don't know you're biased until somebody externally comes in and says, why are you doing this that way? And it takes an external shock to actually nudge you out of that. But you have to be aware now as a business of what your personal biases are and what your corporate biases are and how you're trying to mitigate those and how you're trying to handle them. So I suppose it's not all doom and gloom, but I'm going to hand back to Damian now to talk about solutions. Yes, you could put lots of cost in to try and do this regulatory activity. You could not put the cost in and potentially run the risk of being fined. Actually, there is a third way. You can manage the situation and you can manage your product pricing and you can do what you can to manage, as the regulator put it in their speech, known knowns and known unknowns. So manage what you understand and manage what you don't understand to try and minimise your conduct risk.
Okay, yeah, I suppose the doom side of it is this particularly in the UK mortgage market, is that unprofitability or the squeezing of margins, the big churn in the book, and then there's the gloom side, which is the regulatory side of it. So there is a big challenge. So we're looking at this in kind of three ways. The customer behavioural assets. So it's back to this: how do banks leverage more of that customer behavioural assets that it has through data? How do we execute from a regulatory compliance perspective the operational strategies coming out of that? And how does, say, portfolio technology support all of that? So how do you make it dynamic? It's not just a one-stop show. So on the managing the situation, so what we have done with a number of the UK banks is we've developed what we call a UK mortgage market schema. And what that mortgage market schema is a compilation of a massive amount of data directly from consumers. Okay, so it's not bank data. It's customer survey data. Okay, so that understands across the UK the types of borrowers that are out there, what their preferences are, how do they want to deal with their banks, what kind of attributes they have, what age, what social class, etc., etc. So we get all of that data, and we create this thing called a UK mortgage market schema. And that UK mortgage market schema is divided into 50 borrower types. So this is a segmentation type tool. Okay, so we cluster all of that data and we look at it as 50 type individual borrower types. Now that can change. Obviously, as the market changes, it could be 42, it could be 58 borrower types. And each of those borrower types is unique. So they're either in this direct remortgages quadrant, so they deal directly with the bank, but they're dealing with in remortgaging existing customers. Indirect remortgage, direct and not remortgaged, and indirect and not remortgaged. So the reason why we divide out is because the prominence of the broker channel. Okay, so there is a strong prominence of the broker channel, and most banks deal very differently with remortgages and first-time buyers or new mortgages. Okay, so the 50 borrower types. So this is what the 50 borrower types looks like. So we can then say, well, what does the typical UK borrower type? So borrower type number 14. What does that customer look like? What are their preferences? What is their average loan size? What type of house they have? What type of value of the house is? So when we get this, when we have this data, we then work with the bank to say, well, let's take your data now and let's understand your data, your mortgage portfolio. And let's do some deep profiling of your data versus the market. Not just a benchmarking exercise, but to really understand the profitability and the types of customers. And what we try to do then is to understand each of the borrower types within it in accordance with the schema. We profile that data to understand their attributes, their lending attributes. We model the data to extract lifetime value. So each of these individual customers, what is their lifetime value? We take consideration of expected losses and anything else in it to understand lifetime values of it. Their survival curves and their propensities. So how likely are these customers in borrower type 42 or 46 or whatever, how likely are they to renew that 2-year fixed that's coming up for renewal in 2 months' time? Okay? And depending on that likelihood, what is that kind of price point that you need to position within that borrower type or within the market, depending on LTVs, in order to secure that particular customer? And we establish those survival curves and propensities and then associated costs within it. So are there certain cohorts within the base that are driving value? Are they taking away value? Is there a lot of usage of capital within certain borrower types? And therefore, moving then to understanding all of that, we move into the execution phase. And what we've done with banks is two kinds of execution. One is pricing strategies. So what kind of pricing strategies do you want to adopt in order to maximize return, to meet customer demands, to meet volume challenges and so on? And then non-pricing strategies. So all of this can very much inform, well, what channel should you focus on? What marketing tools do you bring in to ensure that you're getting the right type of customers? What are the products? What are the pricing? Now, from a regulatory point of view, the regulator loves this because what the regulator can see is actually you're using the customer behavioral data to really understand what your customers want. And you've got absolute evidence of how you're designing products or how you're designing and selecting channels or why you're marketing in certain areas. The second part of it, which I'll let Keith cover, is the regulatory situation.
Yes, so on the regulatory front, I've kind of simplified it down to 3 things. If people want more detail, they're more than welcome to come to speak to me later because it's a lot more complicated than this, that most people can do. I think the first one is enhanced horizon scanning. So what I mean by that is basically there's an entire industry that's now developed by firms like Corelytics and a couple of others, which basically go out and look at every piece of regulatory activity and every regulatory file around the world and will then give you a report of what's going on in those. The second one, to Damian's point, is using behavioural analytics and economics. It's very simple. You should understand your customers and make sure you target your products and pricing and strategy to those customers. The regulator, to some extent, will have limited powers to come back for you if you actually do that. The problems they find is if they come in and you said you're going to lend to people who are under 25 earning over £50,000 a year and they find you lend to somebody who's over 50 and earning 15, they're not going to be terribly chuffed. And it's that ability to target your products at your specific customer segments, monitor it, understand it, and make sure you're actually getting the products to the people that you want them to go to. Again, it comes back to the interest-only point, which was they were sold to people they shouldn't have been sold to. And finally, from my experience, be an early adopter. So understand what regulation's coming and adopt it and put it in relatively early. I remember from my MMR experience that the FCA got to the end of, the FSA as they were, then got to the end of that process and very simply said, we've been talking about this for 2 years, you're not getting any sympathy, you're putting it in 6 months. We've given you enough steer of what's going to be in there. And the regulator does have no sympathy on things like European credit directives. If you've had enough lead time, they expect you to understand what's going on and to put the stuff in place. So if you leave it to the last minute, they're not going to be giving you any sympathy.
Okay, so we've looked at the market schema, we've overlaid the bank data and to understand the profiling of that data. The third piece in terms of managing that situation is how do you create that to be dynamic? How do you create an ongoing dynamic focus? And this is the portfolio technology. So again, we've done this extensively in Canada, in the US, and in the UK and other portfolios. It's the platform where we plug in this market schema. We build these propensity models behind it. It has an optimization engine to ensure that you're doing dynamic pricing, scenario planning on a monthly basis, and that's fed on an ongoing basis. And really, what it's to do is in terms of fixed term maturities as they come up and as the market changes, because don't forget, static information is great for a certain period of time, but it needs to be dynamic. How are they going to deal with this fixed term retention? So using the constrained optimization to say, if I want to achieve 87% retention, what do I need to do? What do I need to do from a product and pricing perspective? And obviously the standard variable handling as well. So as rates go up, are we going to see a lot more movement? Because obviously the SVR book in the UK banks is extremely profitable at the moment. But there's a lot of inertia there. What's going to happen in the base rate? And again, this is how we handle the SVR side. So any further information, I'm more than happy to talk about it. I'm just conscious of time now. There is a white paper. I think we might have left that white paper on that kind of mortgage challenge. And it is pertinent to other markets. So I'm sure all of your markets have similar challenges on lending portfolios, and particularly mortgage portfolios. We've just done a webinar release. So we're going to be doing a webinar on the 1st of December. So you can register for that webinar. Winners and losers, the challenges in the UK mortgage market. And clearly, myself and my team are here for the day if anyone wants to have a chat. Okay, thank you.